the driving force of the market. What makes the price of stocks or any other trading security go up and down? Debt, balance sheets, corporate profiles, company earnings, job reports, oil prices, bonds, commodities. Not really. The answer is simple: supply and demand. Anything else is the effect of supply and demand, the desire of buying and selling. Supply and demand is the foundation of market economy. Supply is the quantity of a stock or any other trading security offered in the marketplace and represents the sellers. The sellers are often referred to as the buyers. Demand is the quantity of a stock or any trading security requested in the market and represents the buyers. The buyers are often referred to as the bulls. Sellers and buyers are the yin and yang of the market. When the price of a stock or any other trading security drops to a certain level, $2 in our example, it becomes attractive to the buyers. More buying means more demand, which causes the price to soar up. As long as the supply can meet the demand, the price will keep going higher. When prices go up due to an increase in demand, more buying, or a decrease of supply, not enough sellers, the market is in an uptrend. This type of market is called bullish market or bull market. During an uptrend, the bulls, the buyers, are in control. When a stock or any other trading security reaches a certain level, $11 in our example, it becomes less attractive to the buyers. There is now a reverse situation where those that bought those stocks at $2, $5, $7 or more need to sell them. The buyers become sellers, meaning more supply, which causes the price to drop. As long as the supply exceeds the demand, the price will keep going lower. When price goes down due to an increase of supply, more sellers, or a decrease of demand, less buyers, we are in a downtrend. This type of market is called bearish market or bear market. During a downtrend, the bears, the sellers, are in control. After some time of prices moving up and down, the sellers and the buyers find some sort of equilibrium that maintain the price within a specific trading range. In the image below, we see the price fluctuating from $4.12 to $4.40 in a time frame of 6 months. This type of market is called sideways market. The price will remain within this trading range until something will disrupt the relative balance between supply and demand, causing the price to drop or soar depending on what buyers and sellers are doing. Generally, investors and traders shift from being sellers to being buyers, and vice versa, depending on many factors. Debt, balance sheets, corporate profiles, company earnings, job reports, oil prices, bonds, commodities, etc. Sellers and buyers, supply and demand, are the driving force of the market. Those other factors are simply the cause and effect of supply and demand. Both mindsets are needed when trading in the market. When investors feel optimistic about a company or the general state of the economy, they enter the market with bullish positions, they buy or go long, which starts driving the price up. When they feel pessimistic about a company or the general state of the economy, they enter the market with bearish position, they sell or go short, which starts driving the price down. investors and traders can make money on a bullish market as well as on a bearish market. Successful trading is being able to shift in and out of these mindsets depending on the general perception of the market.